I'm moving all over the place. This thing is crooked. What is wrong with this thing? I think it's crazy. Look at this. Issues. Got issues already, ladies and gentlemen. I apologize. Look at this. I can't do nothing right. All right, nonetheless, we're going to go and get started. Having some technical difficulties. I probably need to get a routine down before I start. But nonetheless, today, first and foremost, everyone, welcome to Financial Literacy 101, where I try to break down complicated financial information to make it very, very simple for you to understand and then for you to go invest or save or get out of debt, whatever you want to do with those things. So today we'll talk about REITs, and I'm going to go through some notes. I'm going to also go through some web pages if you would bear with me. I know I'm off camera a little bit. I'm off to the side. I don't know what's going on. Okay, just bear with me. I'm all over the place here. But nonetheless, this is Ross World. If you're using my channel, I've changed the name a couple of times, but I think I'm going to stick with Financial Literacy 101. It's generic, it's base, but it's quite plain and simple. Okay, so let me get my thoughts together. All right, let me get my thoughts together. And great day to you too, Williams, Sheila. Is it Sheila Williams or is it William Sheila? I don't know if your name is reversed. But anyway, if you're in the chat, go ahead and give me a shout out. Let me know where you guys are actually at. Let me know which state, what country you guys are at. And we're going to get right into the discussion here. We're going to get right into the discussion. We're going to talk about REITs. And the definition I'm about to read to you is from investopedia.com. Okay, I didn't come up with the definition. So most people who give you information on finances or anything else, much time, if they didn't create it or develop or invent it themselves, then they're getting the information from a source. So my source is investopedia.com, and I'm going to give a quick explanation based upon what they have so you to understand real estate investment trust. Okay, that's real estate investment trust. What is a real estate investment trust? A real estate investment trust is a company owning and typically operating real estate which generates income. Most REITs specialize in a specific real estate sector, focusing their time, energy, and funding on that particular segment of the entire real estate horizon. However, diversified and specialty REITs often hold different types of properties in their portfolios. Properties include in a REIT portfolio may include apartments, complexes, data centers, healthcare facilities, hotels, infrastructures in the form of fiber cables, cell towers, and energy pipelines, office building, retail centers, self-storage, timberland, and warehouses. One benefit of REITs for everyday investors is they provide the opportunity to own a portion of real estate which generates dividend-based income. Okay, dividend-based income. We have to understand the difference between if you're building your investment portfolio and you don't have any sort of real estate in your investment portfolio, would it be real property or REIT, then you don't have a diversified real estate portfolio. All right, okay, Sheila. Okay, Sheila from Shreveport, Louisiana. Shreveport, Louisiana. But it could be LA too, right? No. I'm just kidding. But anyway, either in real property or in a real estate investment trust where you're going through a company funding them in order for them to buy and invest in properties for you to receive dividends. Now, later within the segment, hopefully in the next 15 or 20 minutes, I'm not trying to be too chatty today. I'm going to let you see Fundrise. I'm going to Fundrise. Now, I had Fundrise. I told you I've had it about 2 years, but I did sell it. I did some really silly stuff in the beginning because I was testing out all these platforms, okay? And And then I rejoined in, was it March or May of this year? But you're going to see, I'm being very transparent here. I think I have roughly about $2,300. I started Fundrise with the starter package of $500. Because at first, you can only get into Fundrise for $1,000. But when I started, you can get into Fundrise for $500. So I started with $500. I don't have a lot of money to play with, okay? But a lot of my money are in investments and paying down debt. So without further ado, let's get right into what types, what is a REIT? How can I better explain a REIT and the correlation coefficient factor? Okay, so the reason why you need a REIT inside your stock portfolio based upon the correlation coefficient factor is the one positive and the one negative. Or as someone would make it very simple, when the market zig, the REITs zag, or the real estate zag, meaning that they don't operate in the same space, because a lot of times REITs are private investments, private owned investments. Okay. They're not they may own a commercial building, but they're not dealing with state owned property. Okay. So they're essentially private. They're not public. So again, the correlation coefficient factor is when you relate that to REITs and real estate, is basically they're saying when the market, when stocks zig, the real estate zag. You got to have a well-balanced portfolio, well-diverse portfolio. And if you don't want to go out and do real estate yourself, you don't want to go out and buy brick and mortar real estate and make, buy an apartment building. Because I also look at Jay Morrison's channel. Now, a lot of things he say, because he's so intelligent and he built his knowledge from the ground up. Because, at one point, he was incarcerated. I don't know if he was a convicted felon, but I know he was incarcerated. And I don't know what form of education he has, but he's a very intelligent guy that knows all parts of the real estate world. And if you want to get into brick and mortar real estate, then go to his channel and learn from him. Me, I'm more of an online platform investment, guru, that I've been going, really filtering through all the pages saying, hey, where can I do with my current income and grow from there? But I do have aspirations and inspirations of buying brick and mortar property within the next 2 to 3 years, and make sure that I'm renting out to people and I'm not renting from people. Okay. Because I'm renting from people. And here's another thing. Read this. This is a great shirt I got off of Dr. Boy's Watkins channel. 97 of the people who quit too soon are employed by the 3% who never gave up. Are employed by the 3% that never gave up. So that's basically saying 97% of us give up on business, give up on adventures, give up on things that is going to bring us wealth. It's going to bring us financial stability. That's going to leave some sort of wealth for our kids and our family. Okay, so you can't give up in this. And just because you don't understand it now doesn't mean you're not going to understand it later. You ever was looking at a video or reading a book, and when you first start reading, when you first start looking at it, you was like, I have no idea what I am reading. I have no idea what I am looking at. This is far beyond my understanding. Like, I can't comprehend what's going on. But the more you look at it, the more you read it, you start to understand little sprinkles and spots and dots. Like, okay, I kind of understand what that means, and I kind of understand what that means, and then things start to come together. That is kind of how when we're talking about real estate, when we're talking about investments, when we're talking about bonds, when we're talking about savings, if you don't have any knowledge about anything that what I'm talking about, just keep listening. And I assure you, eventually, if you got, a left and right hemisphere of your brain, eventually it'll come together. Or I hope it will come together. All right, let me see something real quick. All right. Hey, Dolly Smith, this is true. All right, thank you. I appreciate that. All right, let's get right into it. Real estate investment trusts are alternative to buying real estate directly. You're not going to buy real estate directly. It's an alternative to buying real estate directly. See, they offer some attractive features of stock investing. They're very attractive because you're going through a company to invest into real estate. So it's almost like buying shares. Now, and granted, I'm gonna show you when I go to my Fundrise that I just bought 108 shares of Fundrise. So IPO means initial public offer. Well, they renamed it because they're only selling on their platform internet public offer. That's just something they did. Now, REITs have been popular investments since their creation, and REITs was created back in the 1960s. Yeah, that's how old REITs are. And you're like, I never heard of this. Well, quite frankly, a lot of information in the financial world is not so much public knowledge unless you dive deep and you actually research these things. Now, only the people in the financial world know this information, but now information is becoming so ready, available that you can just Google about anything, okay? Because we know Bing sucks. Think of a REIT as a pool of real estate, assets traded freely on the stock market exchange. I know it sounds like an ETF. It's because it's a pool of real estate. And we're going to get into that. Now, I've named REITs. The REITs are industrial and office, retail, residential, lodging and resorts, healthcare, self-storage, and specialty buildings. Okay. Now, I got some notes here. Excuse me as I look over. I'm not going to go into vivid detail about each one, but I'm going to give you the pros and cons. Guaranteed dividends. Okay, guaranteed dividends because they're putting money in. They're promising you a certain percentage back. Okay, but we all know that if you are investing, because this is a real estate investment trust, that depending on how the market moves that day, depends on those dividends as well. But what I mean by guaranteed dividends mean that you're going to get something back for your return. Hassle-free real estate investing. Okay, hassle-free. It's a convenient way of packaging into shares that can be easily bought and sold through either a platform or a company. Okay, either a company or a stock market investment organization. There are also REIT mutual funds. Okay, you can go on Vanguard. You can buy real estate investments. Oh, on Stash, one of their portfolios, their index funds is called Retailer O or something. I'm sorry, guys. I wasn't gonna really talk about Stash today, but they have a real estate ETF on their platform. All right, and also with REITs, you have low minimums. You don't need a lot of money to start investment into a REIT, and owning a REIT index fund gives you exposure to the real estate asset class with very little money. Like I said, I started mine with $500. Okay, now I'm at $2,300. Passive investments. I'm not going to insult your intelligence with that. Low stock market correlation. Okay, I talked about correlation and the coefficient factor. REITs historically have a low correlation to other asset classes. This makes it easy to create a diversified investment portfolio by adding REITs. You got liquid cash inside of that when you sell your shares. You have better performance, and what I mean by better performance, while some REITs have historically experienced diminished performance when interest rates increase, many REITs outperform other investments, even in the face of high interest rate, and REITs often outperform other stocks in a slow economy. The reason why REITs outperform other stocks in a slow economy is because everybody needs everyone needs a place to live. Everyone needs a place to conduct business. So we always need brick and mortar places. This thing, when this land was first built upon, there was just grass and we had to build things for shelter to protect ourselves. And then from there, you got residential, commercial, businesses. This think with your big head. You know what I'm getting at. I don't want to insult your intelligence. And then you have mandatory distributions to investor. Now, this is coming from Investopedia as well. This one part here. REITs are companies whose assets consist mainly of real estate holdings. This gives them favorable tax treatment. In exchange, they must distribute at least 90% of their income to unit holders. This pretty much guarantees payout to investors. Okay. Disadvantage of vintage, or your cons of REITs: declining value properties, fees and markups, potential market correlation. That's that -1 plus 1 thing I gave you. Gains taxed at ordinary income rate. Inherent potential limited growth. And the only one I'm going to go up is fees and markups. Because I know you guys heard fees. You're like, oh, I got to pay somebody else to make money. While REITs offer the advantages of liquidity, while REITs offer the advantage of liquidity, trading in and out of a REIT has a high cost. Most of the fees charged by a REIT are paid upfront. These fees are run roughly 20-30% of the value of the REIT. This takes a sizable chunk out of your potential returns. And because REIT prices are set in the public markets, they can trade at a significant premium to the real value of the underlying assets they hold. Sorry, I've been jumping over my words. My apologies. All right, so we know a little bit about REITs, okay? And in the market, if you talk to some financial investors or private investors or brokers, they would tell you anywhere from 15 to 30% of your portfolio should be real estate. 15 to 30% of your stock portfolio should be real estate. Okay. So that is just a guide for you if you're building a diversified portfolio with a certain income, with a certain budget of how much of that should be diversified into REITs. And again, you can go on Stash, you can go on Wealthfront, you can go on Robinhood, and you can invest through these platforms at a very minimum price. With Stash, Stash is $1 a month. Okay, if I can remember correctly, Stash is $1 a month, and once your account reach $5,000 plus dollars, they're going to charge you 0.25% for the year. All right, because when you really think about it, guys, if your account is under $5,000 with Stash, they charge you $1. They're literally charging you $12 a year to use their platform. $12 a year to use their platform every month, right? So it's not more than a lunch, right? You've paid for lunches. Lunch is about $15, anywhere from $15 to $20. You're paying $12 for a platform to reach the stock market in order for you to gain riches and stability and diversification on your portfolios or the portfolios you would be building, okay? So $12 is not a lot of money. Believe me, it's not a lot of money. You spend $12 probably every day or every other day. You know what I'm talking about. All right. So Sheila says, you provide great information, certainly for a beginner like me. Well, thank you. I'm trying to get to those people when they look at other investment channels. It doesn't matter if it's YouTube or not, or CNBC, and they're talking all this stuff about EPS and dividends and capital gains and revenue. And you're like, I know what each individual word means, but what does that mean to me? Like, what does those words and that information mean to me and me building my stock portfolio? Okay, let's move on to Fundrise. Okay, we're going to talk a little bit about Fundrise because that's the one I use. I can't talk about the other ones. And like I said before, I've been investing with Fundrise for about 2 years now, but I did sell all my stock because I did that with Stash too. I sold everything, and then I'm back in the market. Okay, I'm back in the market. I didn't sell all my stocks. I just sold stuff that was on Stash and sold stuff that was on Fundrise, but I still had my Wealthfront. I still had my TSP, still have my 401k. All right, let's get into this. I'm gonna move it over. Give me a second here. And we're gonna go over Fundrise. All right, build a more perfect portfolio. Already they're talking about diversification. They're already talking about diversification. All right, and we're just gonna go down the webpage. We're not gonna do anything. We're not gonna do anything crazy. And we're gonna read a few things right off the website here. Very, very easy. Historical annual returns. They're letting you know right off the bat, we're doing better than 7%. The 7% should kind of be your baseline of ROI. return of investment. 8.7% to 12.4% historical annual returns. Diversify your portfolio with real estate. Maximize your returns with our low fee approach. We just talked about low fee approach in my definitions and in my statements about REITs. Okay. They're taking all the risk by doing real property. Now, they are letting you know they are investing in $1 million projects right off the bat here. This is what I love about it's a very plain and simple website. They're showing you properties that they have and they're showing that it's completed. Either they built it from scratch or they bought it. Now, if you see down here the rating, now green always is good, yellow is moderate, and of course, rating of D1, but just the red color essentially tells you that it could be a risky adventure. And all of these are debt, meaning that people are renting these units and are paying. And the realized return, they're telling you, look at this, 11%, 9%. Then they're giving you pair diversification with performance. Regardless of your net worth, you can now benefit from real estate unique potential for generating consistent cash flow and long-term appreciation. This is a level of real estate investing that was previously reserved for only the wealthiest investors and institutions. And they're giving you the average of returns, of their historical returns. All right. I'm not going to bore you with this, but I'm going to give you the information right here. And this is what investors are saying. Basically saying that Fundrise is good. They don't have anything below a 4.5. Google 4.9. The Triple B, you know, the Better Business Bureau, 4.8, and Trusted Pilot 4.7. I know you're like, I can read this for myself. I know. Here are the three packages. Here's the three plans. Me, I'm in long-term growth. I'm not in a rush to get rich quick. I want my risk to be low, and I want my overall growth and return to be big. So if you see right here, right off the back, they give you, if you want supplemental income, like say for instance, you're in your 50s or your 60s, and you're like, hey, you know what? I want supplemental income. Look at the dividends. Look at the rate bar here. This rate bar is showing you that they're maxing out for you, giving you the most dividends right now. But the appreciation of your REIT is going to be low because we're giving you a higher return of dividends. Then they're giving you the adjustment of both at the total return. Balance investing. If you notice, dividends and appreciation at the same rate, okay? And they have these little excerpts here, build wealth confidently with high diversification. Now, this is the one that I'm in. See how you slow grow? See how the bar graph here is small and then it goes up? Because, hey, I still have another 20 years before I would like to retire, you know, so I want to slow grow. Pursue superior overall returns over the long term. Look at my dividends. They're small. Look at the appreciation. It's big. Okay. And let's see what they got down here. Oh, this is the one I started off with. The 500 minimum. Okay. Most popular choices for new investors. So Sheila, that's for you. You are a new investor. You can start off with $500. And then you have a free upgrade to the core plan. That's once you get it to $1,000, of course. That's something they probably forgot. All right. I can get into why Fundrise, but let's kind of get into, we probably want to know performance. Let's look at performance. And then we'll go right into mine. We invested $2.5 billion in real estate with strong results. And they show you that current Fundrise income versus public investments. Look at this. Look at this. Over 7%. Public bonds, see, that's that Vanguard Total Bond ETF. Now, you know what? Hey, Fundrise, don't be doing that because I invest in that particular ETF. You got to have a well-diversified portfolio, and you got to have bonds, and then you have to have real estate. But when you look at the Vanguard Real Estate ETF, which I have a share or two inside of that, it doubles it. It doubles it. Okay, Fundrise. That's why I invest in so many different platforms, right? I may not have a lot of money in one particular platform, but when you take all my accounts, you're like, okay, he got a little bit of money. He got a little bit of money. That's because I like to even diversify my investment platforms. Now, again, if you're a new investor, I would say go with Stash because through Stash, they have a learning platform that you can actually learn how to invest, get more in-depth knowledge, and you also have transparency. because you need to start somewhere. Don't start off where I'm at because you might get lost in the sauce. Okay, you might get lost in the sauce. So let me see. Resources. Did I click that? I sure did. Now we're going to get into my account. Let's see if my account actually hopefully it didn't time out. Give me a second here. I'm just moving screens over. There we go. All right. I'm going to go to the tippity top here. As you can tell from the top to the bottom, I have $2,300 in there. My net return has only been $19 because that's my dividends, and I'll get into that. Investors since March of this year. Account level is the core. That's the middle one, and then my investment plan is long term. It's telling me because I'm only investing. So you've invested the $100 per month you need to stay on track. You can still add funds. Get out of here. Goal account by 2029. So basically in 10 years, if I keep investing at the rate, they're projecting that I have $25,000. Okay, $25,000. And off to the left here, you see dividends, appreciation, and advisory fees. So my dividends is $18.26. The appreciation is another $1.07, which comes up to be minus the advisory fees of $19.79. Now, some of you are saying, okay, that's not a lot of money. And I agree. It's not a lot of money. But you have to see the projections over time. Now, there's no way they can project how their real estate is going to perform. They can only predict, okay? They can only predict. But we're going to get into some other things here so you can better understand what I'm getting at. Now, right here, I just told you I invested into their IPO, okay? I bought, let's see, 118 shares, I believe. 118 shares. And this is some of the recent activity that they will show you of the property that they bought, okay? And we're going to scroll down. And they'll tell me what properties that I actually have in my portfolio within their website. Because, again, I'm investing into REITs, and they're going to be very transparent about what they're letting me know that I'm investing in, okay? This is a new acquisition in Los Angeles, California. This is 1/4 investment to date. And look at the debt and look at the projected annual return of 8%. And the rating is the blue one, which is shortly of the green. And off to the right here, they have this circle graph of your debt to equity. Okay, your debt to equity. And then again, they have these line graphs here of your projected returns, et cetera, et cetera, et cetera. So you see that the website is clean. You see that it gives you the analytical and metric data for you to do your analysis of your predictions for returns. All right, and now all through this, they're telling me all the property that I have in my portfolio that they invested on my behalf. This is where my money is going. You'll see all the property that I'm scrolling through. Let us look at this one. Let's look at this one. One of your projects completed successfully. This is October 24th, 2019. This is in Jacksonville, Florida. An apartment community sold at a profit. Between the rental income and the profit from sale, we achieved a 22.9% return on this project, which has helped drive the strongest performance of the Growth E REIT. So they're giving to you, they made good money off it. They made 23%, basically. All right, I'm just scrolling through here. And then they saying you received a dividend for the quarter, for the third quarter, for $6.41. So as you can tell, they've been very, very transparent, very, very transparent about everything they're doing with your money. And that's why I love this site, and that's why I love Stash. I don't really like Acorns. I'm not saying that Acorns is a bad platform. I'm just saying they're not as transparent as some others. So let me look at my notes. I'm gonna be very transparent with you guys. Let's see, one of your projects posted their progress report, blah, blah, blah. Okay, whatever. Let's get into performance. And I have to log in. Look at this. YTD, year to date. They're showing me the percentages of the weighted averages that I've been gaining from the time of me owning this portfolio within their platform. And they're giving the percentage. Now, some people don't understand percentage. I'll just give you the dollar amount. And some of you saying these are pennies. These are just low numbers. But we have to understand that my dividends are being reinvested inside my portfolio. And over the course of time, that's going to compound. And again, I picked the long-term growth. The long-term growth one. So mine is going to deal more with appreciation rather than dividends. So what you're seeing is dividends and a little bit of appreciation. Okay. This is projected to grow exponentially over the course of time. Kivo says, I invested under E-Trade. I don't know where my money is going to. I'm sorry, Kivo. Again, I'm just showing people Fundrise because you can see the transparency in this. Let's get into the portfolio. All right. Here are the portfolios. Where they're basically saying that if you, from top to bottom, you have the cost basis, you have the percent of the portfolio, you have the estimated value, you have the position totals. If you just look through these guys, I'm not going to sort your intelligence. It's letting you know what percent of my portfolio is each one. So let's take the largest one, or one of the largest one. Let's take income E-REIT tier 3. Let's see what they show us. And they show us my position. It's 5.6 of my portfolio. Shows me how much it's worth. Cost of shares owned. And then I have 12.7, well, 12.8 quantities of shares in that particular E-REIT fund. Because each E-REIT is a different fund within this Fundrise REIT platform. Okay. This is a REIT platform that invests in different REITs, and different REITs have different properties. So hopefully you understand what I'm getting at. And then it says unpaid dividends, and then unpaid advisory fees, and then it shows me my profit. Okay, then returns, blah, blah, blah. Yeah, you got it. Transactions. I'm going through everything. We're about to get out of here. Look what I just did. November 14th, investment, Fundrise IPO, $1,000 and $1,005. I just did it today. Okay, where did the money come from? Came from my USA account, blah, blah, blah. You don't need to see all that. Yes, take me back. Okay, overview. Anyway, that is a small glance at my Fundrise portfolio, my Fundrise account, so you get some sort of idea of the 3 different ones you could be investing in. So I'm gonna log out. We're gonna go back to the front, and I'm gonna show you. I'm going to show you those 3 funds again for you to pick the one that's right for you. Okay. Here we go, right here. These are the 3 plans to get started. You have supplemental income, balanced investing, and long-term growth. If you want to see more returns now, then you probably want to look into supplemental income, where you're going to be maxing out your dividends. But if you're not so much in a rush, then you might want to choose the balanced investing, where you're going to receive not an equal amount of dividends appreciation, but you're going to see a fair amount in comparison to one another, right? You're going to see more dividends and more appreciation versus a supplemental income. Then with me, you're not going to receive that much income or that much dividends. On income, I was meaning appreciation of the stock, of the fund. All right. Then again, if you choose any other plan, so let me break this down really quickly. If you choose supplemental income, balanced investing, or long-term growth, you have to invest $1,000. If you start off with their starter I'm sorry, that's not the name of it. I forgot the name of this. This is their starter portfolio plan, which is $500. Let me look at one of the details here. Let me look at the details. They're supposed to show you how much that it actually costs to invest, but they're not showing you. Again, a lot of transparency here, a lot of information. I'm not trying to bore you, but it costs you $1,000 if you don't start with the starter plan. Okay, that's how much it costs you. So just take my word for it. It costs $1,000. If you have $1,000 or you're waiting for your tax return, then do it. Don't do the $500. Just go and drop 1,000 there because you're gonna find another way, another reason to spend that extra $500, right? Because a lot of times, some of you already made plans of what you're gonna do with your tax return. You have no plans on investing, saving, or paying down your debt with your tax return. I would definitely say you need to pay down some of your debt. You need to put some of the savings, and you also need to start to invest. Kivo says, I'm interested in Apple, Walmart, Nike, Microsoft. I don't know what the DXCM ticker is. I made some good returns, but I wish I knew where my money was going to. See, you're dealing with E-Trade, and I don't really know that platform. I used to invest with USAA, and I ran into the same issues, Kivo. And they didn't give me the transparency I need to actually know where my money was going. Because we have to understand that the stock market is controlled by information. Information. When things occur in everyday life, in everyday organization, it affects the stock market. When a trail derails with a certain goods of shipment on it, it could affect the stock market. When Galaxy phones explode, that affects the stock market. Because what you guys don't understand, there's probably 100 companies that probably make different intricate pieces of a smartphone to put it all together. And then Galaxy, Samsung, Apple, Google, whoever puts their labeling on it. Okay, they put their labeling on it, or they're probably just all made in China. But even China, within China, it uses different organizations to build that smartphone. So we have to understand that when people are looking at stock news, you're going to hear them talk about organizations and businesses and corporations because that controls the stock market. One of the biggest companies on the stock market is Amazon. One of the biggest conglomerates on the stock market is Berkshire and Hathaway. And Berkshire Hathaway owns a lot of companies. See, a conglomerate is one company sitting at the top like, well, king of the world. And then everybody else falls under them or reports to them or pays them because they essentially own them. Look up Berkshire and Hathaway. That's Warren Buffett's company. Look at the share price. Look at the share price. It's astounding. No one ever looks at this stuff. You know what? We're gonna have a little bit of fun. I'm about to get out of here. I'm not going to bore you. Berkshire and Hathaway. We're gonna look this up real quick. We're gonna look at their stock price. You need to see this with your own eyes. And since I'm already on here, you need to see this. Some of you are really waiting too. Let me switch this real quick. You guys got to see this. This is crazy. This is why they're one of the richest companies in the world too. And people don't know about this company. You better know about this company. Look at this. Berkshire Hathaway. We're talking about one share, one stock of Berkshire Hathaway Class A, because they also have a Class B. I used to own the Class B, and I bought the Class B at $77 a stock. At $77 a stock. Now, I still have a couple of them, by the way, on Robinhood. Now, $328,000 for one share. And look how much they lost today. They only lost 0.22% because their stock is so big that 0.22% of a value of a stock lost them $740. Okay, a decrease in value of $740. This is crazy. I know you're saying, wow. Yes, one share. Now, some people think Amazon is expensive at $1,700 or Google is expensive at $1,000. I bought Google when it was first $500. Look at this stock, guys. Look at this stock. And then you say, okay, let's go 5 years. Could you have afforded this stock in 5 years? Let's see. Back in 2014, did you have $219,000? Or rather, $220,000 to invest for one share? But if you did, and you bought two, look how much your stock would have appreciated in value. Okay. Now let's look at the B one because that's the one I invest in. Let's see. I bought it at $77. I'm gonna look up the Class B. Really? That's what we're doing now? That's what we're doing? They wanted to show me the stock price of Class B. Okay. I guess I gotta go into Yahoo, guys. Okay, so I bought it with $77. Right now it's $218, $219. Okay. So I made some money off of that because they split the stock, but they didn't split the price. They split the stock and they started this one off around, I want to say 70. I bought it at 77. I don't know how much I made. I'm not computing that right now. But I'm just giving you a small synopsis of investing here and a conglomerate that most of you probably never heard of if you didn't hear of Warren Buffett. This is his company. I mean, we can look at it all day. Let's go back a little bit. Let's just look up Berkshire Hathaway. And if I tell you their holdings, who said the CEO is over here? Look at the CEO, Warren Buffett. You see that? This is what we're talking about. This is one of the richest men in America, and people don't even know the organizations he's in. They don't know. And then let's look at the holdings. Berkshire Hathaway companies. Let's look at the companies. I know I'm getting off topic. I know I am. But sometimes we get excited about this information. Look at all these companies. They're a conglomerate, guys. And see, here's the companies that are subsidies of them, okay? And then here are the companies down here that are minority holdings. I'm going to go up. I know I'm going fast. I'm going to slow down. I'm getting excited. The Acme Brick Company. Ben Bridge Jeweler. You see that? Ownership, 100%. Ben Bridge. You know that jewelry shop. Ben Bridge. They own 100% of it. Benjamin and Moore, 100%. Berkshire Hathaway Assurance, 100%. Automotive, 90%. Berkshire Hathaway Energy, 90%. Brooks Sports, 100%. Some of these companies you probably even do business with, and you didn't know who actually owns the company. Court Business Services, you know Court, the people who rent furniture. I know Court. When I was young, I rented furniture from Court for about $180, and it's the dumbest thing I ever done in my life. But that's what low income, impoverished, uneducated people do. And that's exactly what I was. Uneducated, low impoverished, low income, and poor. And I rented furniture for $180. I could have saved up my money and bought my own furniture. They own 100% of that company. So they're just getting people. See, this is all about debt. America's all about debt. Guess what they own? 99%. Dairy Queen. Dairy Queen. You go to Dairy Queen, you get your ice cream, you get your sundaes, you get your burgers, you get your fries, and you're all paying it to Warren Buffett. Yes, you are. Fruit of the Loan, 99%. Geico, 100%. People don't know this. You just think Geico is this insurance company all there by themselves. Nope. Warren Buffett owns it. Warren Buffett owns it. We're talking about REITs, okay? We're talking about REITs, but we're also talking about conglomerates now. We're talking about conglomerates and how Berkshire Hathaway is one of the largest conglomerates in the world, okay? Alphabet, a.k.a. Google's conglomerate, okay, because they own other companies. But this is one of the biggest conglomerates in the world, the Russell brands. Sports equipment, you know Russell equipment. You've seen Russell all over the apparel and all the sports equipment. Yeah, that's your boy. That's your boy, Warren Buffett. He owns it, okay? And there's some other things I didn't read in here that you guys already seen before. Now, notable minority holdings, okay? Now, they're just letting you know that they have holdings in these companies. They don't own them. They have holdings in these companies and a lot of shares. Look at this, Amazon, right? They don't own them, but they have 483,000 shares of Amazon. And guess what they own? Less than 0.1% of the company because Jeff Bezos not having it. He's like, you can have all the shares you want. You just giving us money in our pocket. And look at the value. 904, how much? $904 million. Was that billion? I think that's billion. My bad. No, that's million. That's million. I'm right. That's million. Because the next one is trillion. Anyway, American Airlines. I'm sorry, guys. American Airlines, American Express, Apple. See, Conglomerates buy conglomerates. They make money off each other. But look at this. Look what Berkshire Hathaway, aka Warren Buffett, Big Daddy on the block, is doing. He's doing it and doing it, and he's doing it well. Apple, Bank of America, what else that you know? Charter Communication, Costco's, Delta Airlines, DaVita, General Motors, Goldman Sachs, J.P. Morgan, Johnson & Johnson, Coca-Cola, Kraft, and Heinz. You know, your cheese and your ketchup. Liberty Global, all of those. Southwest Airlines, MasterCard, M&T Bank Corporation, Procter & Gamble. You know Procter & Gamble make the small appliances in your home. You've seen Procter & Gamble. Yeah, your boy Warren Buffett invests inside of it. Yeah, he's a minority holder. He's a minority holder of this, okay? He owns 0.12% of that company. PNC Financial Services, Phillips 66, that's a gas station or a gas company. Red Hat, Sirius XM, that's stuff, you know, the satellite radio in your car. Suncor Energy, another gas company. Teva Pharmaceuticals, Travelers Companies, let's see what else. U.S. Bancorp, Visa, VeriSign, Verizon, and Wells Fargo. Okay? And Wells Fargo. So right there, I just broke down what a conglomerate is and who leads a huge conglomerate. But if you go look up Alphabet and all their subsidiaries, all their companies that they're on, you're going to see a list. It's going to be mainly in tech. But if you see Warren Buffett, his investment mind is so profound that even when he buys companies, he's diversifying the companies he's buying. Now, when you look at Google or AKA Alphabet, they buy mostly tech companies because they also want their technology. I remember that picture company called PISCE, something like it kind of like it was Picasco or Pisciska, something like that. They bought them and they implemented their technology into Google Photos. That's why if you download the Google Photos app, you have unlimited photos. But anyway, I'm rambling. So guys, today we talked about REITs, real estate investment trusts. And I just want to apologize. I got a little bit excited. I'll jumble some of my words, but hopefully you understood the information that I gave to you and how important real estate is for your diversification of your portfolio. You do not have a portfolio if you don't have real estate. And either it's a real estate investment trust or it's brick and mortar real estate where you bought a multifamily home, you bought an apartment building, you bought land, you bought a retail shop, you bought something that can profit you residual and passive income. And if you're doing a REIT, we all know that it's about appreciation of that REIT that you're within, and the dividends reinvesting on themselves to compound to pay you out over the course of time, whether it be today, 10 years, or 20 years from now. Kivo says DXCM is to track people who suffer from diabetes and have high blood pressure. Okay. I thought DXCM was a ticker because you named the other abbreviations of stocks. See, I know Apple, Walmart, Nike, and Microsoft. I know that. I'm familiar with those. But not the DXCM. What is the company of that one? But anyway, now I have about a couple of more minutes. If you have any questions about a REIT or anything that I could possibly answer to help you out, let me know. And again, if you want to request any credit letters, request any information dealing with your student loans, credit deletion letters, anything dealing with financials that you can get off your credit, I possibly have information or letters that you can send to the creditors, the collection agencies, or that corporation to either make out a payment plan, to get it off your credit, and also to help your credit so you can do, other adventures and business adventures with your credit, like getting a loan or something like that. Hopefully I helped somebody today. Again, I'd like to apologize. I was jumping over my words. I was just so excited because I really wanted to do this video about REITs because this is great information that a lot of people don't know. And Fundrise is not the only REIT-based platform. Okay, they have another one out called Rooftop. Then there's another one that just came out. So I would do my research on those before I go with Fundrise. Okay, before I go with Fundrise, I would do my research on those because they may be better. They may have a better, they may have a better platform. They may have a better strategy. Okay, that's what I'm saying. That is that I'm with Fundrise. I like Fundrise. There's nothing wrong with Fundrise. They've always been gaining. So I'm going to stick with Fundrise. That's it. All right. Since you guys don't have any questions, I'm going to go ahead and get off here, guys. I wish you guys a really good day. And if you're investing already, I hope you guys made some money today. I really hope you guys made some money today. I don't even look at it. I'm not going to bother myself. I used to look at that stuff every day like, oh, man, yeah, I made $10. Oh, yeah, man. And then I invested in Tilray. Yeah, I invested in Tilray. And I don't have Tilray no more. I invested in Tilray, guys. I want you guys to look up Tilray. I bought it right before it spiked. It spiked up to almost $200 a share. And then it's like $20, $30 a share. Yeah. But anyway, that's my sad story for today. Anyway, guys, if you want any information, like I said, I haven't. Just request it. My email is in the description of this video. And my email is blacklogic28@protonmail.com. All right. Peace and blessings to you all. I wish you all a wonderful day. This is Financial Literacy 101.